Okay, welcome back to the Beats the Odds of Business and Wealth podcast, Trevor.
Here we are again.
Fourth week. Okay, so we're going to talk about mortgage interest rates today. Hey?
Okay, I'm excited about this one because, just recently my wife and I put down an offer on a home, and we're going for a mortgage, and I'd like to get into it with you on that.
Yeah. So let's get into it. We'll walk you through kind of my decision making process. So I think it's good. I think we might have talked about this before, but like, how do I start my day every single day?
Yeah.
Is I'm counting what I call the fake money. So maybe I want to understand the fake money before I do my client meetings every day.
All right.
And so, first thing I come into the office, this is what I've done for years, is I look at a couple of key indicators. And if we pull them up on the screen there, we can show kind of the thoughts in my head,
Sure,
what we're going through, my head before I talk to clients is, first of all, I look at the price of oil. It's, what I believe underpins the entire system. It's the primary source of energy across the entire world. And if I see oil at $67 a barrel, it tells me that, it tells me that people are pessimistic about the world economy.
Sure.
Overall at $67 a barrel. Okay. Pessimistic about the world economy and maybe optimistic about some geopolitical events too. So those two things can tug against each other.
I wonder
right?
what geopolitical events are happening right now. There's only like half a dozen to choose from.
Yeah,
Right?
yeah. But I guess that's how serious the market is taking them right now at 67. So then I get into the S&P 500. People who have attended our boot camp know that I don't own a lot of U.S. stocks, but it is the primary market in the world, and I want to understand that indicator. Okay, and we are virtually at all-time highs, and that's very, very key here. So I want people to understand. It's like I'm looking at a one-year chart here, but let's back it up to the max. We are at all-time highs.
This looks like it's a historic all-time high.
Yes, and that ties into our interest rates. Where are interest rates going? Okay, so we have that. I look at U.S. Treasuries, and so the TLT index of the long-term bond index in the U.S. is kind of a good way to get a quick and dirty overview of U.S. long-term bonds. And some people would say that it's the U.S. It's the U.S. Treasury market that underpins the entire financial system. I was like, yeah, they're right. But I would say if you look deeper, it's energy. Without energy, nothing happens. So
This is true.
Want to look at that first, right? Really, really important. Then I look at the USD to Japanese yen exchange rate. Okay, and that might seem strange, right? But Japan is the world's third largest economy, and they're the largest foreign holder of U.S. Treasuries. And so, I've been saying that for a while, that I think people are worried about some sort of economic cliff or crash or something like that. It's like, I don't know if we're going to have a Lehman Brothers event, but I think what happens in Japan matters a lot. And that was proven correct earlier this summer, right? And so we see it right now that we had that peak here, and that peak led to an eventual bit of a temporary crash in the Japanese stock market. Actually, I don't know if I have that one. Let's look. Let's just go Nikki. There we go. So what happened, where that peak here at 161, 162 yen per USD, eventually that led to this, a giant crash in the Japanese stock market. And what that led to were comments by the Bank of Japan saying that they were no longer going to increase rates, even though they'd only increase rates to a quarter point, 0.25, coming up from negative rates.
Oh, wow.
So that's how highly indebted they are. I guess that's what happens when you get over, 200% debt to GDP. And, also comments from U.S. Federal Reserve saying that if there was enough chaos that they would step in and intervene. And there was talks at the time about, an emergency rate cut. That didn't happen, but eventually we did get a real rate cut on the scheduled event, right?
Yeah, just a week ago.
That's right. And you can kind of see that it had stabilized, and it really started to stabilize before the U.S. cut rates. But I think the comments were what stabilized the market. I don't think if there was no comments, it's like that thing would have kept torpedoing. And if that keeps torpedoing, all of a sudden Japanese investors have to sell off their U.S. treasuries.
Oh, no.
They would have to sell off U.S. treasuries, which would, in effect, crater the S&P 500. And that's, that's the series of dominoes that would fall.
So if I'm hearing you correctly, the U.S. government basically said, if they get into further trouble, the money printer's going to fire up and we're just going to
100%
get it out.
100%. That was basically what happened, right? And, then we move on to the Canadian dollar versus the U.S. dollar. Surprisingly resilient lately.
Yeah, I'm kind of shocked by that.
Surprisingly resilient. I think if someone would ask me that the Canadian government, the Bank of Canada would have cut rates 3 times before the U.S., would we not at least lose some ground on the U.S. dollar? But we really didn't. We didn't really lose any ground. And even with oil at $67 a barrel right now, holding pretty strong at 74 cents on the dollar. But I think there's actually very good reason for that, and I don't think people are getting a lot of attention to it. So we're going to get to that.
Right? All right, let's get into it.
And we look at the TSX, also all-time highs.
Okay, so we got the S&P 500 at all-time highs, and we've got the TSX
all-time highs, right? Then we get into the real money.
Okay.
The real money that's been money for, 5,000 years.
Okay, where's real money at?
All-time highs. Okay, so we're talking,
Holy
in
jeepers.
Canadian dollars, we're at $3,600 an ounce in Canadian dollars. Okay, let's make sure I'm, measuring that. But it's also at all-time highs in USD too. And so, some would say that's, that's a reflection of geopolitical tensions that, people are expecting geopolitical tensions, but that does not agree with the oil price. You could say that, okay, the market thinks that there's extreme geopolitical tensions, and that's what's driving. I actually listened to a podcast on my way here today,
okay. All right.
And that was this, theory that gold is going high because of geopolitical tensions. But I don't agree, because if that was a singular reason for driving gold price higher, it would also drive the oil markets higher. That's effectively what would happen. So I don't think that's what's going on here, right? Okay,
so what is driving these asset prices to go through the roof here?
Yeah, what is, what is it? Okay, let's look at the U.S. Federal Reserve, the history. Well, we look at on the Canadian side, it's here's our rate cuts, okay? We went from 5 to 4.75 to 4.5 to 4.25, the Bank of Canada rate.
Yes.
Okay. Here is the prime rate at this point. We're at 6.45. Okay.
Yep.
6.45. Okay. And looking at the U.S. side, they're now, down from 5.5 down to 5. Okay. Now, why is gold prices, really racing? Why are all asset prices really racing?
Yeah, all asset prices except, I guess gold's a commodity, oil is a commodity, not necessarily an asset.
Yeah. And I read an article. I should have saved it and brought it, but it was an article on it was Bell Media or something, one of the big Canadian ones, and they went, a whole, 1,000 words or whatever on what their thoughts on gold prices are. And you know what the one thing that they didn't talk about once? They didn't talk about one time about what gold prices are so high. It's they didn't talk about that the U.S. government is $35 trillion in debt. So they tried to explain the price of gold without mentioning the fact that the U.S. government is $35 trillion in debt.
Yeah.
And I was just, I was just reading it. It was just nonsense. nonsense, like utter nonsense. Like that is the reason why gold prices are rocketing, right?
35 trillion. And these are the people that give you a credit score. All right. Okay.
$35 trillion in debt, right? Like the Western nations of the world are, almost comically in debt at this point, and people just do not have the confidence in the money. And so that's why gold prices are going higher. And, I've been screaming this from the top of buildings from 2022. It just became painfully obvious to me. I did not own a single ounce of gold before 2022 because it's, wasn't the fastest horse in the race, in my view. It was like I could get better risk-rated return somewhere else. But as soon as 2022 happened, COVID ended, but the spending didn't end. It became increasingly clear to me. It's like, I better get a bunch of gold and Bitcoin. Like this is going to happen. Like whether I think it's, investing in a shiny metal rock, became a good idea. It's like, it only became a good idea because that became such a bad idea, right?
Yeah. Wow. That's incredible. So the national debt's going crazy. How can they do that? How are they continuing to do this?
I mean,
how is everything still staying together with that much, debt in the U.S. market?
It's a brand, right? It's like, why can Hermes sell a little decorative bracelet for $1,000 that costs them $5 to make? You know what I mean? You walk down the road to Ardene's and they sell it for $10 or something, right? It's like it's a brand, and that's going to be around for a while. It's like it's valuable because people still say it's valuable, right? Even though it's like, it's no different than at its essence, it's no different than the Zimbabwe $20 billion bill, right? I mean, they got a bunch of gold at Fort Knox, but not nearly enough to back 35 trillion, right? Like it's not close. So, that's what's happening. And it's like, we saw this because people, they saw interest rates go up. And I told everyone, it's like, the prime rate of interest in Canada has been 4.25% to 4.5% for decades. Like that's been the average prime rate in Canada, right? But people look for the big peaks and the big lows, and I'm like, you're thinking about buying a property, you're thinking about doing something. It's like, it should make sense at that, right? You should look at that average rate of, that average interest rate, because that's kind of where it's going. But just like rough math, you start looking at $35 trillion. Even if you roll 35 trillion, over at 5%, okay, just rolling that over, it's like the interest expense that the U.S. is going to have is going to be, 1.7 trillion.
Yeah,
like
so,
just rolling over the existing rates, right?
So not going to be able to afford the tax debt.
Yeah, like
right?
that would drive the deficit from 2 trillion to that's going to drive the deficit from 2 trillion to 2.7 trillion with no other increase in expenditures, at all, right? And so, people were at the height of it when interest rates are going up, and they're telling me, it's like, oh, remember the 80s, it's going to go to 20-some%. It's like, there was 1/3 the debt levels in the 80s. So roughly speaking, 7% interest was just as painful as, with 3 times as more debt, 7% was just as painful as 21% in the 80s. Like, that was the stress on the economy that was going to happen, right? At 20%, it's like, we're talking financial Armageddon. Like the credit markets as we know it would seize up. Like it's just, who is going to buy the treasury, who is going to buy the treasury bonds? It's like you're seeing less and less. People are, it's not like a cliff where people are selling off U.S. treasury bonds across the world. It's like they're slowly getting out of them. They're getting out of them and they're getting into gold, right? Mm-hmm. And, on the margin, some are getting into Bitcoin, right? Mm-hmm. And, that's the same time I started buying Bitcoin was in 2022.
Yeah.
And I'm actually a pretty conservative investor, right? And so for me to take a big allocation into gold or Bitcoin, it's like I had really good reason to do so. And like, here we are. It's like, but it was kind of an easy trade. It's not because I, really believe in gold. It's interesting, right? But it's it's a fixed asset as opposed to money that can just roll off the printer. It's like you got to actually get in the ground, you got to mine it, you got to refine it, and you got to produce it. It's like you can't really fake the physical gold. But in terms of treasury bonds, money printing, 100% you can do that, right? And so when you have that, it's like I see a lot of people, they have to understand that where are Canadian mortgage interest rates going? It's like, well, I mean, the safe bet, the probable bet, and there's always like, no one can predict the future, right? But the probable bet is it's going back to the historic averages. And anyone who doesn't view that as their base case, it's like, oh, it's definitely going to crash to zero. It's definitely going to go back up or definitely stay there. It's like, why? Based on what evidence? There has to be a really compelling argument to tell me that it's not going to mean revert back to, the prime rate of interest being, 4.25%, 4.5%. Okay. And so, you're looking at a Bank of Canada rate of 2, 2.25%, 2.5%, maybe. That's it, right? That's where directionally we're going. But it's like, are there risks that it could stay higher for longer? It's like, yeah, probably stayed a little higher for a little longer than most people thought, right? Could it go back up? I mean, it's possible. Is it likely? No. The likely is it's going to mean revert. But what's more probable? Is it more probable that the interest rates are going to go up from here? Or is it more probable that interest rates are actually going to go back down below the baseline? And I tell people, it's like, look at what we're dealing with here. It's like, who is indebted the most? It's the governments around the world, okay? The governments around the world. And who controls the rate of interest? The governments around the world.
That's right. So maybe explain to people the separation between the governments and the Fed, because the Fed is not federal and it's not a government agency.
It's not federal and there are no reserves.
Not federal and there are no reserves. So maybe describe that a little bit, because we have the massive interest on the debt. The Canadian government, same way, and the Fed in the U.S. So maybe explain that a little bit so that we get a better understanding of who exactly we're indebted to. So if the interest rates go up and they can't afford to service that debt, what happens at that point?
Well, I mean, they have to. They will be able to afford it because they can print the money. As long as the interest obligations are in their own currency, they'll be fine, right? It's, when do you get the currency crisis like the Southeast Asian currency crisis in the 90s? It's because they have debt that's not in their own currency, right? And so their own currency starts to get devalued, but they still have to make the interest and debt payments in someone else's currency, i.e. US dollars. Then you have a problem, right? So would the U.S. ever default? No, not on a nominal basis. On a real basis, though, they're going to print their way out of it. Like, they're going to print their way out of it because what has to happen here is they have an economy of $28 trillion in size. They have to raise enough tax revenue, okay? And you can come up with all kinds of crazy, tax policies. People will say tax the billionaires. It's like, oh, okay, tax the billionaires. I think people have like added it up. Like if you confiscated, forget about taxing the billionaires, just confiscate all their wealth. The U.S. government could operate for like 18 months. Like, it's like, then what? Then what's your plan, right?
Then what?
It's like you can only have any sort of reasonable taxation off the off your GDP. And so what they're going to do is they're going to print a bunch of money, okay? And then it's going to be easier if this is, say, $40 trillion. It's going to be easier to raise enough tax revenue off of this to close this gap here, okay? And I mean, what does that mean? All of the asset holders are going to get richer. So all the people who are currently rich are going to get richer, and all the people who are poor are going to get poorer. Completely unelectable position, but a mathematical certainty to happen because there are no other options at this point. Like, there just are no other options. Like, all of the, you just see the stupidity of like the Jagmeet Singhs of the world saying we're going to come after the Canadian grocers of like what, for their single digit profit margins. Like, just step back and like start calculating the math of what people are asking for. It's like they're completely broke, and they're either too stupid or they don't want to admit it, because if they admit it, it basically, tells people a very bleak outcome. And you have to get assets. Like, you
Yes.
have to get assets.
Yes.
And borrowing in these fake paper dollars responsibly, borrowing responsibly in the fake paper dollars is going to help you get ahead of it, right? And how do I believe this? Is like, I mean, people who might know myself, like, I had millions of dollars of me personally, millions of dollars of variable rate interest debt going into the debt increases. And a lot of people, they're going to say, oh, why didn't you lock in? It's like, I'm dealing with commercial financing, and there's a lot of different restrictions on that. So most people who, they've only ever financed their $500,000 house or $1 million house. I'm dealing with different instruments and different properties and different businesses, right? But did I care? It's like, no, I didn't care, because all my ratios were fine. My liquidity is fine. I have multiple streams of income. It's like, it doesn't really matter to me. It's like, I know it's going to mean revert, right? It's just that ultimate confidence. It's just like, I know it's going to mean revert, because if it didn't, financial Armageddon would hit, and financial Armageddon would hit long before I'm struggling to make my payments.
Exactly. And it's not just, people like yourself. It would hit all of the people who have that massive debt. So like you talked about before, there are companies out there, like, the largest companies in Canada and the world, they hold a certain amount of debt.
Yes.
And if they can't service their debt, then we have a commercial, lending crisis. We'd have a commercial property crisis. We'd have, like you said, financial Armageddon, because it wouldn't be able to service it. And also the government of Canada and the US would run into troubles. I mean, they could just print their way out, but at the same time, that devalues our currency. So it just makes the asset prices go up and makes everything more expensive.
Yeah. So, I mean, where are Canadian interest rates going down? They're going down. And like that's the likely scenario. And the risks of, like, is it going down to the average and the mean, is like, the risks are actually to the downside, not to the upside, right? You look at what the probabilities are. It's like, if you just look at life as kind of a bell curve, it's like the most probable, solution is they're going back to the mean revert. Okay, we're going to get prime rates back to 4.25, 4.5, right? But between the two options, which one's more probable, to stay at 5 or 6, or go down to 2 or 3? Going down to 2 or 3 is actually more probable than staying at 4, because the governments around the world who effectively influence the interest rates are the most indebted entities of all. And they do not want to justify their tax revenue going out the door just to pay interest. It just looks like an uglier and uglier stat. So they're going to print money, and quietly the rich people will get much richer and the poor will get much poorer. And it's like, I think more people are waking up to it. I think people should have seen it during COVID. Is like, they gave everyone $2,000 a month. They just literally handed out the money, $2,000 a month. Here you go. And what happened is they turned around and bought stuff from companies owned by rich people.
Yes.
And all the money just goes to, like, the shareholders of those companies.
Yeah. So rather than the check, going from the government straight to those companies, it kind of goes through people, and they buy the stuff that basically transfers that money over to their
how did they pay for it
in history.
Is they confiscated the value of your labor. They printed the money, would effectively confiscated the value of their labor. So, I mean, basically any government running a deficit is like, it's ultimately friendly to the people who already have wealth and assets. And that's kind of the likely outcome. Now, do I think inflation is going to come roaring back? Yes, but probably not how some people think. I just want to look at the US M2 money supply here. Okay, and we're just looking at this. It's like, what happened with inflation? People are like, they look at a lot of like backwards indicators for inflation. Okay, and so, but ultimately, in order for prices to rise, you have to have more money in the system. And this is the US M2 money supply, okay? And so you can see what happened here is what predated all of the inflation. So from 2020 to February 2022, it's like that's where the money printing happened, okay? That was the quantitative easing. That's where the money printing happened. And the money supply is probably the best forward-looking indicator we have for inflation. Like, because ultimately, how are we going to drive the prices of goods and services up if there's less money in circulation? And so if you want to know where they're going, it's like, well, first you have an increase to the money supply, then you have an increase in those asset prices, then you have an increase in goods and services, then inflation happens. So if you're looking for the forward-looking indicator, this is probably the best forward-looking indicator you have to inflation.
All right, so what is this chart telling us?
This is the total US M2 money supply in circulation, okay? And so M2 money supply is, basically like liquid cash, okay? Relatively liquid cash that's available in the system. Canada, I tend to look at, you can look at M3 money supply, but the problem is in the US, M3 money supply includes all the foreign money supply, so it gets a little squirrely. But, Canada M3 money supply, it's not like there's a huge amount of foreign entities holding Canadian dollars, comparatively speaking, but there's a lot in the US. So M2 money supply is, kind of being held within the United States. So it's interesting to look at there. But you can see we haven't really moved on the money supply that much. Okay, we haven't really moved on the money supply that much. And so my outlook for inflation, as far as the fake government CPI inflation, it's going to be kind of muted. It's going to be kind of muted. Eventually, will they print money? And will this money supply? Yeah, that they're going to print money because they're running a massive deficit. Right. But at this point, they've kind of drained. They've kind of drained overnight facilities, and they haven't really increased the money supply that much. And historically, roughly a 6% increase in the money supply here will give you the 2% on the fake CPI. Okay, of course, historically you could have just bought ounces of gold and got 6%. That's where it's coming from, right? Because they're increasing the money supply. But when they jack enough with the CPI numbers and put more flat screens and take out enough desirable assets, it's like they can get to 2% eventually. So 6% in here will give you the 2% in the CPI, which is the headline number where the central banks make decisions. But really, until this starts to creep up, this will likely creep up first before inflation runs rears its ugly head. And really, 6% would yield 2%. So they increase the money supply by 6. Historically, that's given you kind of those 2% CPI prints. And really, there's been no increase in the money supply in 2 years. None. We're pretty much at the same level. You see kind of the dip and the increase, and we're not even back to the highs. So this is a very distorted chart, and this is a massive chart. This is back to 1960. And it's interesting to see this inflection point here in the 70s, coming off the gold standard. It's that's kind of where the whole regime took place. So when you look at that, it's what's the risk for interest rates not coming down? The risk is massive CPI prints, but until you see massive increases to the money supply, that's unlikely to happen. Okay, I do think you're going to see spikes in this eventually, but that's based on forward policy, and this is basically you put the money supply out there first, and then 12 to 24 months later you get the inflation. That's kind of what happens in this process.
A little bit of so it's forward thinking, and then you see the effects afterwards.
Yeah. So Bank of Canada meeting 8 times a year, moving down by a quarter point every meeting, and we end up at 2% less than where we are today. Okay, which would put us right smack dab of where we are, where we are historically, right? Between 4.25% and 4.5%, and that's the likely outcome here. But at the same time, it's what's happening is look at the price of gold. It's what's the price of gold? The price of gold is telling us that the market does not like this. The market does not like the fact that The market does not like the fact that there's a $2 trillion deficit, that all of these loans are scheduled to roll over into, say, 5%, and that interest expense is going to $1.5 trillion. It's like the market doesn't like that very much, right? And, what's happened to long-term bondholders over time is, that's not the Bitcoin chart or some meme coin. That's the long-term treasury bonds that are supposed to underpin the entire financial system. Is they've been absolutely obliterated over the last 5 years. They've been absolutely obliterated, and
is that because of the money printing, the increase in the money supply?
Yeah, time people want less and less U.S. Treasury bonds and more other assets. They want gold, they want Bitcoin, they want infrastructure, they want power plants. It's like they don't really want U.S. Treasury bonds.
Okay, let's bring it back to the average Canadian who here are trying to beat the odds of business and wealth.
Yeah.
Let's bring it back home to someone who wants to get into their first home, right? To start buying that asset, a real estate asset. How is that going to affect the asset price for the average person? Because the average person has their full-time job, and maybe two people working in the household, and they're wanting to get into a house. How is this going to affect that asset price?
The likely scenario is the rates are coming down 2%, and that increases the value of that asset they're going to purchase today. So if they're going to purchase today at a prime rate of 6.45, and within a year, prime rate's going to be 2% lower. That's the likely outcome, and that asset will trade for a higher price because more people can qualify at a high, for a higher mortgage on that, right?
So more people into the market able to qualify for the same piece of property. So the property price or the property value is going to increase.
Good window right now. Like it's a good window right now. It's like we still don't have we haven't overcome this with supply. We don't have major supply coming online, right? I see some of the people look at the horror stories online and someone getting margined out. It's like people who get margined out just made bad decisions, right? Some people have millions of dollars in debt and sleep very easily at night because their margins are so good that it doesn't matter, right?
And by that you mean they have enough liquid to pay their debts, and it doesn't really matter if it goes up a point, 2 points, or whatever. They have enough to service that debt.
That's right. That's right. What's your overall debt to equity? What's your liquid assets? What are the income streams that you have? How resilient are there? How many is there? What it's going to be like to replace some of them if it happens. Like those are the questions people need to ask, not should I be debt free? It's like, okay, you can try to do this without debt, but it's like trying to win a drag race with a pickup truck.
Yeah. If you could do it without debt, then the governments of the world and large companies out there would do it without debt. But they don't. They use debt. They leverage debt in order to expand their business, expand their portfolio, and to pay for stuff, right?
Yeah. So, the average Canadian needs to look at the likely scenarios. Interest rates are going down probably by about 2% on variable rate mortgages. So you're going to get a full 2% down. If you were to sign a variable rate mortgage today, it's probably within a year that rate's 2% lower, right?
Yeah.
And historically, that's always been the case. Like variable rate mortgages, if someone just shut their brain off and went variable every time, they always win on a 25-year roll, right? And now, could you pick better on a 5-year? You could, but the banks don't give you a fixed rate out of the goodness of their heart. They charge you a risk premium because they're taking on the risk of giving you the fixed rate, okay? Whereas on the variable rate, it's like it's very clear when you look at the historical data that variable will win. Of course, someone has to have the liquidity to enter into a variable arrangement, okay? So they actually have to know that if rates do go up, that they're not in the bottom 10 or 20% that's going to get margined out of that trade, right?
Yeah.
Because that happens, right?
Yeah, and that's why in the mortgage industry they have the stress test, right? So you got to qualify for 2% above whatever rate your mortgage is at, right?
That's right.
Which is yesterday when I was working on the numbers for my mortgage, I had a mini panic attack because the qualifying rate was like 8.15%. Yeah. And it was a little bit stressful. I mean, we could do it because we could just add some more in the down payment and everything worked out with the numbers, but a mini panic attack. And I was thinking, okay, so there's some really good deals out right now for a fixed rate mortgage. I'm wondering, because I know that the average is between 4.25 and 5%, right? 4.75. Then maybe if I just locked in on that historical average rate, would that be a good choice? And from what you're saying, it seems like that could probably go for the adjustable rate mortgage.
Yeah, I mean, the most probable scenarios, rates are 2% lower now. It's like, could it be higher than that? They could, but it's more likely. So not the base case scenario, but rather than stay higher for longer, it's more likely that it'll actually go beyond the 2% because the governments around the world, too much of their tax revenue is going to pay the interest on their debt.
They're broke,
and they can effectively make the they can influence those decisions, right? And you can walk through it. It's like, say they can't influence decisions. It's like, they darn well can influence decisions, because like even in the Bank of Canada, it's like, it's separated, but it's like, okay, the Prime Minister appoints the Finance Minister, and then the Finance Minister appoints the committees to select the to select the Board of Governors, and the Board of Governors selects the leader of the Bank of Canada, right? And they can remove at any time and start the process over. So they darn well can affect the decision, right? They might not be able to affect the decision tomorrow, but they can affect it over the long term if they want to, right? Especially new governments come in and they're going to put their people in there, right? Because they're going to want the desired outcome. And so their desired outcome is basically to make it seem like everything's okay and turn the money printer back on, because the alternative is major devaluations in the currency. So hopefully that's helpful to someone. Hopefully it gives them some confidence to go out there and say this is where rates are likely to go. And the main thing is like the main risk is holding on to the fake paper, which is definitely going to get devalued by our governments. And so we got to get some real assets and take some responsible debt to do it. And that's probably the path to beating the odds at wealth in Canada.
All right. Thanks so much for joining us. Don't forget to like, subscribe, and share this podcast wherever you have Canadian people who want to beat the odds of business and wealth. Thanks.